Saving for a home is no mean feat, and getting your deposit together is just the beginning. Once you've saved up your deposit amount, there are other costs to factor in before you can step onto the property ladder. Depending on the size of your deposit, you may have to add LMI to this list of costs. So what exactly is LMI? It's short for Lender's Mortgage Insurance. It's an insurance policy that protects the lender from financial loss if the borrower can't afford to meet their home loan repayments. LMI is often confused with mortgage protection insurance. Contrary to popular beliefs, LMI is not designed to protect the borrower if they default on their loan repayments. Borrowers may bear the cost of LMI, but its purpose is to reduce the risk for lenders. When is LMI needed? Generally, you'll have to pay for LMI if your home loan deposit is less than 20% of the total value of your property, or in other words, if your LVR is more than 80%. How is LMI paid? If your lender requires you to take out LMI, usually it can be paid upfront as a one-off payment as a part of the settlement process. Alternatively, it can be capitalised, or in other words, added to your total home loan amount. If the LMI amount is added into your loan, you'll generally be charged interest on it along with the rest of your loan. How is LMI calculated? LMI is a percentage of your loan amount. The percentage varies depending on how much you've borrowed and your LVR. The bigger your loan, the higher cost of the insurance. This accounts for the potential loss to the lender in the event that you default on your loan. For example, if a first home buyer decides to take out an owner-occupier home loan with a 5% deposit on a property valued at $400,000 over a loan term of up to 30 years, they would pay approximately $11,897 in LMI. In comparison, the same borrower with a 15% deposit would pay about $3,770 in LMI. There are other factors that may also affect the cost of LMI. Some financial institutions and insurers may charge different LMI costs for investment and residential property purchases. Employment status can impact how risky the lender considers the borrower to be, which may affect the LMI premium. Lastly, there are several providers of LMI, and just like any other insurance product, premiums can differ between institutions. Do I have to pay LMI again if I refinance or buy my next home? LMI premiums are typically non-refundable. If you switch your loan to another provider in the future, you generally won't be able to transfer your LMI to another lender. Can I avoid paying LMI? If you're looking to avoid paying LMI but you don't have a big enough deposit saved up, you may be better off pressing pause on your home ownership dreams for now and waiting until you've saved up the 20% deposit generally required to avoid paying LMI. If you do wish to get into the market sooner with a smaller deposit, you could consider applying for the federal government's First Home Loan Deposit Scheme. Under this scheme, 10,000 eligible first home buyers can purchase a modest home with a deposit for as little as 5%. Buying a home is not a decision to enter into lightly. It's important to know what you're getting into. Speaking to a qualified advisor, doing relevant research, and running the numbers will help you make an informed decision that best suits your personal circumstances and your money goals. Don't miss out on the next chapter of Money Dictionary. Like and subscribe to get our latest videos and stay financially savvy.